big pleasure.
My mic.
Yes,
Ah,
I am going
thank
to
you.
visit this.
Okay, thank you very much.
desert
It is an honor to be here in this just
1 month
spectacular
from now.
location
Yes, I'm very
to talk
interested.
about
I saw
monetary
it in
policy
YouTube.
and global
Fantastic.
imbalances.
They made a many Western.
So for my presentation today, which is a summary of a much longer paper, which I wrote for this session, I'm going to try to answer two questions. First, has there been convergence or divergence between and within advanced economies and emerging markets with respect to monetary policy and global imbalances? And then second, after summarizing that analysis, what are the implications for global growth and resilience? So to do that, my comments will be split into four sections. First, I'll talk a bit about monetary policy, focusing on rate cycles, a new way of thinking about central bank actions around the world. Second, I'll then talk about global imbalances, focusing on positions in stocks in global imbalances. Third, I'll then draw links between the analysis of global imbalances and monetary policy. And then finally, I will wrap it all together by talking about the spillovers from some of these trends we've seen over the last few years and what the implications are for global risk and resilience, focusing on risks around international wealth effects. So since there's a lot of material I'm going to cover in a quick amount of time and summarize a lot of material in the paper, let me just give you a quick summary of what the key takeaways are from this. First, focusing on monetary policy, there has been substantial convergence in the monetary policy of emerging markets with advanced economies. This is not all emerging markets. There's still substantial heterogeneity in how monetary policy is done across emerging markets. But for the majority of emerging markets, they are now setting monetary policy in a countercyclical way, similar to how advanced economies have been doing this for a number of years. This is good news for the global economy. Second, shifting to global imbalances, in opposition, there has been an increased divergence in global imbalances, primarily a divergence within advanced economies, not emerging markets. And within advanced economies, this divergence in global imbalances is primarily caused by a growing divergent position of the United States. And in particular, a large increase in the net international debt position of the United States. Bringing that all together, this is good and bad news for the global economy. The good news is the greater use of countercyclical monetary policy in emerging markets, combined with the transfer of wealth as global imbalances have grown from the US to the rest of the world, has provided important support for the global economy. It's helped smooth business cycles in emerging markets. It's provided a tailwind of resilience in part of the stronger growth that we have seen over the last few years. Looking forward, though, there are substantial risks because of this growth in imbalances, and in particular, this unsustainable position of the United States. When this adjusts, how it adjusts, will have larger spillover effects and be an important headwind in the rest of the world that I don't think is fully appreciated. Okay, so that's where I'm going. Let me jump right in with the first section on monetary policy. So I'm going to discuss the convergence of monetary policy between and within emerging markets and advanced economies. To do that, I'm going to pull from a new approach to analyzing monetary policy that I've been working on with two co-authors at the World Bank, and we've analyzed what we call the rate cycles of advanced economies. Now, we define a rate cycle as a period of easing and tightening in monetary policy, similar to how we, for decades, have been analyzing business cycles of periods of recession and recovery in economic activity. So we have a methodology and an algorithm we use to look at monetary policy decisions across countries and define periods of easing and tightening to constitute rate cycles. And what we've done this before and analyzed this for advanced economies, but for the conference today, we extended this methodology to emerging markets. So we now have a sample of about 56 economies, 38 emerging markets, and dates of the rate cycles in each of these economies based on monthly data. And this is just an example of one of this what comes out of this dating algorithm for Chile. The black shows the policy interest rate. We look not just at adjustments in policy rates, but also overall balance sheets. The red is the start of easing cycles for monetary policy in Chile. The purple is the start of tightening cycles. And you can do this for countries around the world and have this fantastic database of when countries' central banks start easing and tightening monetary policy. Once you have those dates, you can then look at all sorts of really interesting statistics to understand rate cycles around the world. So let me just give you a sample of some of these statistics that you can analyze. One thing you can look at is the synchronization in rate cycles around the world. So this graph in green shaded area shows the share of advanced economies that are in a tightening phase. The white above it is the share in an easing phase. The dark green line is the share of emerging markets in a tightening phase, and above that is the share in an easing phase. And the first thing that jumps out at you is these waves of tightening and easing cycles. And this shows that there often are global shocks where a large share of advanced economies and emerging markets simultaneously shift to tightening or easing monetary policy. But there's also some phases where there's not these big humps. And that's when the global shocks are not as big and monetary policy is determined more by domestic shocks and domestic activity. What also jumps out at you in this graph is that in the 2000s and 2010s, there's some synchronization between rate cycles of advanced economies and emerging markets, but the dark green line is not on top of the green shaded area. Instead, in the 2000s, there's some period, or in general, advanced economies were raising rates more than in emerging markets. 2010s, it flipped. It's only in the last 5 years or so, since 2019, we've seen highly synchronized rate cycles between emerging markets and advanced economies. They've all largely eased policy, tightened policy, and then slowly shifted out of that back to easing, largely in synchronicity. That's not surprising given the scale of the global shocks we've just experienced. So let's dig a little deeper. Not just at who's easing and tightening monetary policy, but what do these phases of tighter monetary policy and easier monetary policy look like? So to look at that, we dig a little deeper with these statistics in this new database, and we can look at all sorts of characteristics of what a tightening phase looks like or an easing phase looks like in advanced economies and emerging markets. So there's a lot on this graph. Let me walk you through it. So for each of these graphs, the left side are characteristics of tightening phases, the right side are of easing phases. The gray bars are for advanced economies. The blue is the same statistic for emerging markets. The diamonds are medians, the lines are means, and then this shows the 10 to 90% range for each. And then each of these is a statistic of a tightening or rate cycle. And the first thing I want to point out is let's focus on the purple diamonds or the purple bars. These are the medians and means for advanced economies and emerging markets. And what should jump out at you is that those are basically the same across emerging markets and advanced economies, especially the medians. What that means is that the median, so middle of the sample, emerging market, adjusts interest rates, tightens or eases monetary policy for the same length of time as advanced economies, duration. They make the same number of adjustments to their interest rates. They raise or lower interest rates at the same pace, and the total amplitude of rate changes is roughly the same. So that's a striking amount of convergence in how the median emerging market is adjusting monetary policy compared to the median advanced economy. That is very different than what has happened in the past. Granted, there still are some differences. In particular, the bands are a lot bigger for emerging markets. That captures the greater heterogeneity across emerging markets. There are more differences in how emerging markets set monetary policy, different frameworks, different regimes. Also, the medians are higher for some of these, or means are higher for some of these for emerging markets to capture that in some emerging markets, inflation is still higher, interest rates are still higher nominally. So there are still some differences, but the median, sort of the majority of emerging markets are now setting monetary policy in a very similar way in terms of the length of phases, the amount of adjustments, the number of adjustments, the size and pace is done in advanced economies. So bottom line, emerging markets are using countercyclical monetary policy quite effectively and similar to how advanced economies have been doing so. So that's a very important development. You can also look at how this corresponds to economic activity. There's lots of charts in the paper. For example, it clearly shows that as inflation picked up after COVID, emerging markets were quite a bit faster at seeing the risk in raising interest rates and tightening monetary policy compared to advanced economies. So if anything, emerging markets over the last few years, again, on average, have used monetary policy even more forcefully and more countercyclically than seen in many advanced economies. So very important development. One just final set of comparison before I shift to global imbalances. Where are we now? So this graph on the left shows where policy rates are settling now as compared to in the 2010s or 2000s for emerging markets on the left and advanced economies on the right. And again, the black bar is the mean, the red diamonds focus on are the medians. And you see this very remarkable progress for emerging markets. Interest rates have come down. They've gone up a bit today, as they have in advanced economies. So rates today are higher than they were in the 2010s, but not by much. In advanced economies, rates have gone up more compared to where they were the last decade. I think most impressive is the graph on your right, which shows how emerging markets are doing in advanced economies at meeting inflation targets. So for the subset of emerging markets that have explicit inflation targets, this captured how close they are to meeting those targets. Focus again on the blue diamonds, the median performance. Emerging markets have done better each decade at meeting inflation targets. And that's very impressive how their performance today is better than it has been over the last 15 years, given the severity of the shocks and the spikes we've seen in inflation. Emerging markets are doing quite well in terms of meeting inflation targets. Still not doing as well as advanced economies, who are on the right. They tend to be closer to their inflation targets. But advanced economies, we're actually seeing a bigger range in how they're performing than we have historically seen. Emerging markets, their performance is just getting better and better each decade. So bottom line, all of this is good news. Emerging markets are using monetary policy countercyclically, quite effectively, to counter swings in economic activity and stabilize economies against shocks, and they're getting better and better at meeting inflation targets. Next, second point, global imbalances. Is there also a similar convergence in imbalances? Here, the news is more worrisome. So the left graph shows a measure of global imbalances, the stock of imbalances. Basically, the top is net creditor positions. The bottom is net debtor positions around the world. The darker shade is emerging markets. The lighter colors is advanced economies. And the key thing to take out of this graph on your left is just the fan is growing. That means the size of imbalances is growing over a fairly short amount of time, particularly since 2000, imbalances have grown quite sharply. To really accentuate that, the graph on the right just calculates the divergence in this measure of imbalances. So it's the absolute value of international creditor and debtor positions. The purple line shows the total growth in global imbalances, and it's been quite steep, especially the last few years, has been growing quite sharply. But then what's interesting, if you break down this growth into how much of the growth in imbalances is occurring within emerging markets and how much in advanced economies, you see it's largely an advanced economy story. The red line shows the growth of imbalances in emerging markets. It's gone up a little, but it's pretty flat. The black is the growth in imbalances in advanced economies. So advanced economies are the culprit behind this growth in imbalances. So which of the advanced economies is to blame? If you break down this graph on the left into individual countries and regions, you see there is one culprit. The dark gray there, that is the United States debtor position. It has grown quite sharply and really dominates the graph. And this just captures the size of the US international debt position is quite large. And this is not just US government debt, which is often the focus. These graphs of imbalances capture the overall debt or asset or liability position of a country. So it's the debt and assets of a government, plus the corporate sector, plus the financial sector, plus the household sector. And that has grown quite sharply in the US. Who's on the other side? You know, if you have debtors, you have to have creditors on the other side. The other side has been more stable. The blue is Japan, which is at a fairly large creditor position for an extended amount of time. Red jumps in there around 2000. That's the growing creditor position of China. That's large. That's part of the story. But it hasn't grown at least through the end of 2024 when our data stops. There is some evidence it's growing more now. This graph on the right just breaks out the emerging markets in the sample. So those of you in the room, some of you can find yourself on the graph. And there you see of the emerging markets, the big creditor position is China, with some contribution in black from Saudi Arabia and Russia. So global imbalances are growing. US is a big part of the story in the change, the deterioration over the last 15, 20 years. What's driving that? So we do a lot of analysis in this paper. We go country by country. What exactly is driving these changes and imbalances around the world? Some really interesting patterns, different forces in different countries. But in the interest of time, let me just summarize some general patterns on average across countries. So this breaks down what is driving imbalances in advanced economies on the left, emerging markets on your right, the 1990s in the left bar for each, and over the last 5 years on the right bar. Blue is the role of trade in driving imbalances. That's often where we focus. It's where a lot of the politics is, how trade flows are driving imbalances, especially in the US these days. And what you see is trade is an important part, driving imbalances, plays a bigger part in some countries than others, particularly China, it's quite large, plays a bigger role for emerging markets in driving changes in imbalances, but its role has fallen quite a bit over time. Instead, what is playing a bigger role is the green and red, which are financial effects affecting imbalances. The green is flows of income. The light green is largely investment income. A lot of that is interest payments across borders. The darker green is other income payments, which include remittances. Those are not surprisingly bigger in emerging markets. But I think what really should jump out at you is the red. The red has become more and more dominant, and that is valuation effects. That's changes in the relative valuation of equity markets in bonds around the world. And if you break it down further, what has been very important over the last 15 years has been changes in the relative value of US equity markets relative to the rest of the world, combined with the fact people outside the US hold a larger and larger share of US equities. So changes in US equity markets are having bigger spillover effects around the world. So what's all that mean? Now let me tie this together. So I show you some patterns with monetary policy, convergence in monetary policy around the world, combined with a divergence in global imbalances. How are these related? So in the last graph I just showed you, a key relationship is financial effects. Global imbalances are growing primarily because of financial market effects. And I'm going to show you how that breaks down into two specific financial market effects. One, which is closely related to monetary policy, is flows of interest payments across borders. So what I'm going to do here is I'm going to look at interest payments, across international interest payments over the last 15 years, 2010 to 2024, which is scaled by each country's GDP. And this shows how much they paid in interest on bonds and bank loans. You'll see there's a couple of countries on the right where the number's positive. Countries such as Switzerland and Japan that have large asset holdings, large bond holdings, have been net recipients of interest flows, and that has contributed to their positive positions in global imbalances. But most of the world, including emerging markets, which are in the darker color here, have been paying interest to the rest of the world on aggregate. And the size of these interest payments are quite large and contributing more and more to global imbalances. On average, the emerging markets over this 15 years have paid 11% of GDP in interest payments. That's roughly double what advanced economies pay on international interest payments. So that contributes to global imbalances. But looking forward, as monetary policy is converging more between emerging markets and advanced economies, and interest rates in emerging markets are falling closer to advanced economies, and advanced economies' rates are moving up by more, these payments should fall. So if there's no major changes in relative debt positions, which is a big if, but ignoring that effect, we should see some of these contributions to global imbalances through interest flows fall. That's the good news. Now, the more worrisome pattern is what is happening in the second financial effect I want to show you, which is valuation effects. So that was the red in the last graph I showed you. It has been the biggest driver by far of the growth in global imbalances over the last 15 years. So what I'm going to show you now is just to get you a rough idea of the size of these valuation effects. So this shows you the change in your international investment positions, basically the change in your imbalances, due to changes in the value of your international holdings of equities in FDI. You will see on the left some big negatives, especially the US. The US has actually, as its equity market has outperformed that in the rest of the world, there's been very large transfers of that wealth around the world. So it's what I call a generous giveaway of the US. US equity market has boomed, partly because of AI and tech stops, and those gains have been shared around the world. To capture the extent of those gains, on the right shows the gains in the international investment positions of other countries. Those gains have been very large, from these valuation effects. Red, again, is emerging markets. On average, emerging markets over the last 15 years have gained 30% of GDP from these valuation effects. That's a big transfer of wealth to emerging markets from the outperformance of US equities and FDI. That undoubtedly has been part of the resilience we have seen the last 15 years. It is part of the tailwind that has supported global growth. So that has been good news so far, but the worrisome thing is going forward. So the final part of this presentation, I want to just think about what scenarios if this unwinds. What should we be worried about? What does this mean for resilience of the global economy? The global economy has benefited from this net transfer of wealth from the US around the world. What if this reverses? Just to make you sort of think about the context, some people say the US imbalance really isn't that bad compared to other countries. For example, the graph on the left shows the US international investment position relative to each country's GDP. US has a big one, was about 90% of GDP, biggest of economies, but it doesn't look terribly out of line with other countries, especially surplus positions of some countries. Why we worry so much about the US position, not because I am from the US, but because when you rank the US position relative to global GDP, it is a massive debtor position. We have not seen an imbalance like this in the history of the world, at least that I can find data. So US is running a huge debtor position relative to global GDP. Even a modest adjustment in that relative to US GDP is going to have very large spillover effects around the world. And let me just give you one super rough back-of-the-envelope estimate of what it could look like. Let's take a scenario that we've heard about today. AI stocks in the US are revalued. This ended up being largely a bubble, at least in terms of the equity market valuations. Let's say equity markets around the world fall back to where they were at the end of 2019. So before the sort of AI bubble took off, markets all around the world fall some, but they fall much more in the US, reflecting the higher share of AI. What's the transfer of wealth around the world? So this is, again, holding everything else constant. No exchange rate moves, there would be other adjustments. What happens? US actually gains on net because basically the hit to the equity market is shared around the world, but this shows the hits to countries around the world. They are very big. Good news is they're smaller in emerging markets because they do have less equity exposure overall, but it's still big. For example, South Africa, Brazil could have hits of over 10% of GDP because of a transfer of this net wealth effect, a loss of net wealth in their economies. Okay, so just to conclude, I covered a lot of ground. Let me just quickly summarize. Recent developments in monetary policy, good news, convergence in how emerging markets are using monetary policy, using it countercyclically, very effectively to smooth shocks. In some sense, even more effective, more countercyclical monetary policy in emerging markets, but with a caveat, there is still a lot of heterogeneity across emerging markets, very different policies, which we'll hear about in this panel. Global imbalances, the news is more disturbing. There is a substantial divergence in imbalances driven by a large US debtor position, and these changes are driven more by financial effects, so they could adjust very quickly, and there could be a bigger shock than sort of slow-moving trade effects. When you put the two together, the convergence in monetary policy and divergence in imbalances has provided a very important boost to global growth to date. It's helped economies smooth their economies against shocks. It's also provided a very substantial tailwind of net wealth transfer from the US to countries around the world. But this also means the world is now more vulnerable to a series of shocks, whether it's a fall in US equity markets or a depreciation of the dollar, which will likely be part of the adjustment. The spillover effects could be much larger than we have experienced in the past because of the much larger size of these imbalances. Thank you.